Hello, this is Alexander Green, Chief Investment Strategist with the Auction Club. And today I want to talk about the inflation that we have, the rising interest rates, and the threat of a recession and how it affects you as an investor and what you should be doing about it. So let's start with the general overview. Obviously, last year we had the highest inflation in 40 years. That's coming down. The Federal Reserve was way behind the curve, taking interest rates too low, leaving them too low for too long, and has now been playing catch up. And we've had a regional banking crisis in addition that's also created uncertainty in the economy. The regional banking crisis was caused by too many depositors having more money than is guaranteed by the FDIC, which is a $250,000 limit, and a couple of banks like Silicon Valley Bank and Signature Bank having a very narrow base of depositors. So that when one group started pulling deposits, then it started a run on the bank. With Silicon Valley Bank, it was technology companies. With Signature Bank, it was crypto companies or crypto related companies. So, how does this affect the economy? Well, for the most part, the effect of the regional banking crisis is negative because it tightens lending standards. And when it's tougher to get money and that money is more expensive, it has a drag on the broad economy. And this is exactly what the Federal Reserve is trying to do, is to engineer a slowdown in demand in order to give inflation a chance to keep falling, which it is doing. So between the slowdown in the hiring, the moderation in wages, all these things are slowing down economic growth, and there's a threat of a recession out there. Now, are we going to have a recession? Well, even professional economists disagree, and no one knows for sure. But here's the important thing to realize as an investor. First of all, there are many, many more recessions and expansions left ahead of you as an investor. Many more bear markets and bull markets ahead of you. Some people act as if being caught holding stocks in a recession or a down market is some mark of shame. It's not. Now, when will the market recover? We don't know for certain. However, we do know that you can't predict recessions, you can't predict bear markets, but we know that nothing outperforms a diversified portfolio of common stocks over time. And even if we do have more of a bear market or a recession ahead of us, not every stock is going to decline. Some stocks are very recession resistant. Food companies, for instance, utilities, drug companies, medical device companies. And these are the areas that you want to concentrate on if you're a defensive investor. If you're a more aggressive investor, technology companies are adding to the productivity of the U.S. economy, making our lives easier and more convenient, and those companies are going to prosper as well. So if you're more aggressive, you can lean toward technology, more defensive, more toward food, drugs, utilities, and so on. But the idea of getting out of the market and with the view of getting back in when things look better, that doesn't work, because when things look better, stocks are higher. The market will turn up long before sentiment or the economy turn up. So you really want to stick to your guns. You want to have an asset allocation. You want to diversify broadly, and you want to target those individual companies that are likely to do well, regardless of what lies just ahead for the economy and the market. So that's it for today. If you want to subscribe to this YouTube channel, and I certainly hope you do, click on the link below and become a subscriber. So that's it for today. Thanks so much for joining me.